The market's gone crazy this week. Stocks are up and down worldwide, and these big international events are quietly hitting your wallet. After the Fed's rate cut, Wall Street was mixed. Does volatile trading reflect the tussle between policy expectations and economic reality? China orders tech firms to stop buying NVIDIA's AI chips. Does this mark a new phase in China-US tech competition? How do earnings of FedEx, Lennar, Darden Restaurants, and employment data show the market economy's resilience? Does rising initial jobless claims and divergent corporate earnings signal higher U.S. recession risk? Hey, I'm Cheese, your money buddy. Today, let's recap the recent big events that have shaken global stocks and see how they're affecting your cash. On September 17th, the Fed cut rates by 25 basis points to 4.00% to 4.25%. Powell called it a risk management cut and stressed no prolonged easing, triggering the market's buy the rumor, sell the fact move. U.S. stocks swung that day. The Dow edged up 0.57%, while the Nasdaq and S&P edged down, showing investors split views on policy and the economy. The Fed was deeply divided on future rate cuts, too. Of 18 officials, 2 backed another 25 basis point cut, 9 favored a 50 basis point cut, and 1 even supported a hike, shaking market confidence in policy consistency. Currently, there are policy-driven and conflicting economic data. If employment and inflation fail to support a soft landing scenario, this will only intensify. Therefore, in the short term, focus on policy volatility, prioritize stable defensive assets, and focus on interest rate-sensitive sectors. Per the Financial Times, China told leading tech firms to stop buying all NVIDIA AI chips, even existing orders, and launched an antitrust probe. This is both a counter to U.S. tech blockades and a key step to boost domestic semiconductor independence. NVIDIA's 2024 China revenue accounted for 13%, around $17 billion. The ban may leave it with inventory backlogs and lower revenue. Chinese firms may switch to AMD or domestic suppliers, reshaping the global semiconductor landscape. This suggests that China is actively striving to break free from dependence and achieve technological independence. Competition between China and the U.S. in artificial intelligence and semiconductors will intensify. Therefore, avoid U.S. chip stocks that rely on China and focus on domestic semiconductor chains and alternatives like AMD. FedEx's 2025 fiscal net profit rose 11% to $4.09 billion, but its 3.8% revenue growth, lower than pre-pandemic levels, signals slowing consumer demand. Lennar, the U.S.'s second-largest home builder, saw a 9% drop in new housing starts in Q3, dragged down by high rates curbing home buying. Darden Restaurants' Q4 revenue rose 10.6%, with strong same-store sales, showing the service sector's resilience. The U.S. economy is experiencing structural bifurcation. Weak manufacturing coexists with a resilient services sector. The market may shift its focus from technology stocks to defensive sectors. We recommend reducing holdings of cyclical stocks, real estate, industrials, and increasing holdings of consumer services and consumer staples to balance portfolio risk. Initial jobless claims rose for 2 straight weeks, with the September 6th week far exceeding expectations. Layoffs spread from tech finance to retail manufacturing. If this trend continues, consumer spending, which makes up 70% of GDP, may be suppressed. The Fed has cut rates by 100 basis points with no clear effect. The market fears it will be caught in a dilemma between protecting employment and controlling inflation, possibly hiking rates early in 2026. A recession is not yet certain, but cooling employment and income disparity pose risks. If third-quarter GDP growth falls short of the expected 1.8%, the likelihood of a recession will increase. We recommend reducing holdings of cyclical stocks and high-valuation technology stocks, and increasing holdings of defensive assets, short-term treasury bonds, and utilities. Adjusting positions based on GDP data. Let's also check out what's coming up next. Will the Fed cut rates by 25 bips as planned? CME FedWatch says the market's fully priced it in. Snap up interest rate-sensitive assets on dips. The ECB's still hawkish. Inflation's at 2.1%, close to target, and the chance of a rate cut this year's dropped to 15%. Hold off on European cyclical stocks for now. JP Morgan's $18 billion tech investment is almost here. It's got enough capital to expand, so the fintech sector might have lots of opportunities. In short, finance isn't distant data. It's tied to daily life. Understanding these trends helps avoid investment detours and plan ahead. What do you want me to cover next? Let me know in comments.